Hi, I'm Chris Kingema from Landmark Wealth Management, and today I'd like to discuss portfolio construction and how we build portfolios for our clients. We really look at this as a three-step process. First, looking at the stock or equity portion of the portfolio, we're big believers in using index ETFs, otherwise known as exchange-traded funds. When you look at the ability of an active manager who's buying individual stocks and trying to beat their stated benchmark, the numbers historically are not too good. Matter of fact, there's been a lot of studies from firms like Vanguard, Standard and Poor's, many others, that show the ability of any active stock picking fund manager and their ability to beat their stated benchmark is very low probability. And even if the ones do it in any one given year, if you look over the next year or two, their ability to stay in that top decile, as an example, becomes even worse. So our goal is to keep expenses extremely low, look for tax efficiency in the portfolio, and that's why we use index ETFs, otherwise known as exchange traded funds, to participate in the broad-based market indices within and across asset classes, and those will give us market type returns, which for most people over a given period of time will get them to their stated goal. On the bond side of the portfolio, we actually take an exact opposite approach. There, the research shows us that using active managers in the fixed income space actually adds value, and it's done on a more consistent basis. So when you look at fund managers who have beaten their benchmark, the really good ones tend to do that consistently in many years. And it makes sense when you think about it because the bond market is really, there's no exchange that bonds trade on. It's a dealer driven market where firms go out, buy bonds into their inventory, mark them up in price, and then resell them. And when you look at the additional complexities of the bond market, especially over the last several years, where we've had interest rates rising, the decisions about duration of bonds, credit quality, what types of bonds should we be in? Should we be in mortgage backed or corporate or government? Those decisions, we want the best bond minds in the industry making those tactical decisions. And for those, we use exchange traded funds as well as mutual funds. Lastly, we overlay this with a strategy called the dividend aristocrat strategy. And sometimes people hear that name, dividend aristocrats, and they think, well, you must be buying companies that pay high dividends. And not necessarily the case. What we're looking at are firms that have a long term track record of consistently raising their dividend each year for a specific period of time. Some 10 years, some 15 years, some even up to 25 years. And what that tells us is if you can consistently raise your dividend every year, for example, up to 25 years, these are most likely fundamentally strong companies and proven track records and good management. And why that's important is when you have periods of market volatility, those kind of investments tend to go down less during those volatile times. Yet when markets are doing well, they tend to capture about 90% of the upside. So when we're dealing with people of or near retirement age in particular, where protecting downside becomes so important, the dividend aristocrat strategy makes a lot of sense. We welcome all questions. We spend a lot of time going over all of the investments in great detail before we ever implement anything. And feel free to give us a call, set an appointment, and we'd love to speak to you and go more in depth about some of the topics I just mentioned. Thanks for watching and have a good day.